Think back to 2008. Markets were in free fall. Global uncertainty was the only sure thing. Businesses stopped spending. Lenders stopped lending. M&A activity came to a sudden halt as capital retreated. Everyone took refuge on the sidelines.
People were a little bit worried about what's going to happen. What is the future going to bring us? So things slowed down a little bit. We saw that there wasn't as much capital being invested in companies. We saw that the transactions had slowed down a lot. There was really not that much happening in the market. The institutional investors seemed to be holding their breath as well. So you didn't see as much capital being deployed at that time period.
Fast forward to today. There's lots of cash to invest. Balance sheets are strong. Corporations are looking for investments, and lenders are opening their wallets.
We're seeing that there's some of the investors coming from overseas. We do have some Americans coming in to buy here, possibly because their economy is not doing as well and they're looking for other markets. We've seen potential acquirers coming from India, from Asia, from Europe.
There is a tremendous amount of capital that's available. The numbers that get thrown around as far as private equity is concerned, they say there's $1 trillion of what we refer to as dry powder, which means buying power, equity, undeployed equity capital that's been committed to these private equity groups. And if you look at strategic buyers, they've got more cash on their balance sheets than they've ever had historically.
Big money is searching for opportunity. A large segment of recession-battered private enterprise owner-operators is looking to cash out. Could this be a perfect storm?
There's a boom effectively going on here, and the list of people that want to be a part of that is incredibly long. But based on what we see in the marketplace, like I said, with '08, people are holding off. But eventually the floodgates are just going to have to open. So there's going to be an incredible amount of opportunities coming to market.
Buyers are more cautious than ever. Due diligence demands more rigor. Sellers have to understand the difference between strategic and financial buyers.
The buyer universe has really bifurcated into strategic buyers and financial buyers. Financial buyers will always drive their value off of an internal rate of return calculation, which is fine. And the way they do that is by leveraging the equity that they put into these deals. Financial buyers aren't going in to run businesses, they're going in to back management teams. Strategic buyers typically, they're going to be looking at internal rates of return, but they're looking at different attributes. They're looking more at what are the synergies? What does this do to me competitively? Is it a defensive position? Is it rounding out a category, where I'm underdeveloped, if you like, or under-indexed? Is it adding some capability that I don't currently have? They're looking more longer term and strategic versus financial buyers.
How do owner-operators prepare their businesses for sale? Do you know what to expect? Do you have a number? Do you have the resources to assess opportunities?
Well, when I talk about grooming a company, it means to make sure that the financial statements are clean, make sure that you have a client list that is attractive to people. Current clientele is something that is important to people because you have certainty of future earnings. So depending on the industry, you want to make sure that you have a good client base.
I think people in the venture capital industry will tell you that the most important asset that they're looking for when they want to invest in a company is management. Management.
Management is key because the financial buyers coming in to back a management team. Growth. Is there a good growth profile in the business? Are there acquisition opportunities in the business? Does it have good margin? Is it defendable as far as the market position? Has it got a good return on invested capital?
Every business is different. Every situation is unique. It takes time to prepare a company for sale, and it takes expertise, proven science, and the experience to apply it. And only one profession in Canada is focused solely on business valuation.
We have the ability to assist them in either transitioning in a business from an owner business to a management team business and getting the value of the business in those assets that they're eventually going to sell.
It's also a good idea to get a CBV in early so that everybody goes into any sort of sales process with their eyes wide open. Oftentimes entrepreneurs have too high an expectation. They're personally invested in it. They've done everything since this company was formed to where it is today. So their expectations are often a little bit out of line with the market. And I think what CBVs help do is help bring you in line with the market. Not necessarily from your perspective as a seller, but what a buyer might think. And you get that buyer's perspective.
Surround yourself with good advisors, including a solid CBV transaction advisor to help you through the journey.
Chartered Business Valuators. Be certain